Oh, Ann Manning is telling us that she lives in the mountains also. She lives in Magnolia, which is 200 feet above the sea level, and she feels that the air is a lot better than that in Houston at only 79 feet above sea level.
Well, there you go.
She's in the mountains too. All right.
Good for mountains. Hooray for mountains. All right, well, welcome everybody to the August 15th, 2023 edition of Bull Sessions. My name is Mark Robertson. I am joined here by Ken Kabula, along with special guest Kevin Gillogly. Say hello, guys.
Hello.
Hello, guys.
All right, really looking forward to this. We have talked about Value Line and Arnold Bernard a couple times in the past, but it never hurts to come back in. And Kevin and I were kicking around this book a couple times over the last month, and it really is kind of interesting how, and Kevin, I don't want to put words in your mouth, but it really does align with what we do try to do at Manifest Investing. Is that your take also?
Very much so. I'm reading this, and I almost felt like this is where you got your the premise for what you were doing.
Yeah, it definitely aligns quite a bit. And what I find fascinating, we're going to cover it. This book was actually published in 1958, and so much of it holds true today. And we'll get deeper into that story as we go. And we are going to emphasize quality, and we are going to spend some time thinking about if we had to pick a basket of stocks for the year 2048, what might we be looking at? So that's where we're headed. Any other comments, guys?
I like the idea. I'm reasonably certain I won't see if I'm right or wrong, but I like the idea.
I've got a lot of doubts of myself.
Your grandkids will. Your grandkids will, Ken.
All right.
Well, that is important. All right. Well, speaking of hot dogs, this is our weekly reminder that Portillo's is not sponsoring this session, although they should be. And down there on the lower left, we covered this last week, but this is the picture of the full boat. That is the answer to the question, what type of nautical vehicle could you buy if you started selling hot dogs in the 1960s on the streets of Chicago and do it well? Because that is a boat owned by the former owner of Portillo's. And the name of that boat is Top Dog. There you go. So, Kevin, when are we going to get to see your boat?
I think it's going to be right after my club makes some of its purchases. I see. I'm continually reminded by one of my club members who's in the audience there. In fact, this weekend, he reminded people that weren't in my club how I put the kibosh on InMode in our model club, and it immediately shot up. And so he still is reminding me, and I'm going, well, at least I didn't have one that really sort of cratered, like, I don't know, maybe A2 Milk.
Yeah.
Or SCP Pool.
Or iRobot.
All right, moving along, gentlemen. All right, the stuff that you hear is, of course, involves decisions that are solely your own. No investment recommendation is intended. This is about education. We're going to revisit some history and some formative stuff and try to learn from it. Everything that we do is for education, illustration, and demonstration. So you'll hear opinions from us. Please do your own homework before making any investment decision. If we own something, we'll try to remember to talk about it. We do have a monthly program called the Roundtable, where if we had invested in the round, as we have for the Roundtable for the last 13 or 14 years, we could afford a boat. Maybe not the size of that boat on the previous slide, but pretty good results, 15 to 16% annualized rate of return, and a lot of good, clean fun. It is a monthly webcast, last Tuesday of every month, generally at 8:30 Eastern Time. If you'd like to be added to a reminder list, nkabula1@comcast.net. Anything else here, Ken?
No, I'm ready to forge ahead here, Mark.
Okay, let me see if I can decode the machine here. Get the Madden pen ready. All right, not going to talk a lot about this, but I did switch back to the Value Line low total return forecast. The shape of the curve's the same. The numbers are slightly different. And we'll spend some more time talking about that in a future broadcast. you can see that the average low total return forecast is down around 7% right now. And we will spend a lot more time talking about that in the future. 10 years ago, we basically established the fact that the actual returns tended to match the value line low total return forecasts. That has changed over the last few years, and now it's probably a true low forecast, but we will cover that in greater detail later. And let's just keep pressing on. Here's just a quick look for those of you that wonder how this would compare versus, you've seen this chart for the value line median appreciation projection. And all I did was substitute in the low total return forecast. As you see here, again, the shape of the curve is exactly the same. I tend to think that they do track pretty well with some special periods like you see here, and then here's your bubble from the last few years. Other than those two incidents, it actually has tracked pretty well. And value line has become, I know many of you out there are not going to believe this, a little less optimistic with their forecasts across the board over the last several years. All right, so we'll just keep moving on. Every week that we find one, we try to include a reminder that the long-term perspective matters. And this is another one of Ken's favorites.
I just like the visual clarity of a take this one, folks, and show it to your investment club. You hold stocks for 20 years, you've reduced practically to zero. I'm not ever comfortable with saying that it's always going to be zero, but let's say it's 0.01. But you've reduced the ability to, or the probability of losing money to almost nothing if you hold stocks for 20 years, and you follow a few simple rules. You have to be realistic, and you have to buy stocks at a time when you have the opportunity to make some money in them, and that's the method that we've been using for a long while, trying to beat the market by 5 points, trying to aim at consistent growth in sales, consistent growth in earnings, and not worried about spicing the portfolio up occasionally with stocks that don't meet all that criteria that I've just spoken about, but keeping the core of your portfolio, the majority of your stocks, keeping them in that idea where we're going to have nice, dull, boring stocks that 20 years from now the company still might be around and it might be making us 10 plus a year. That's where we'd like to be.
Yep. So Ken mentioned the number, again, the number that we constantly hear, long-term returns for stock market investing are in that 10 to 11% range. So there you have it. All right. I ran into this graph just a few days ago, and this one kind of knocks me out because I listened to a whole bunch of people expressing extreme consternation about the rise in interest rates and what it's going to do to wreck the capital condition of many companies. And to me, this is just staggering. There's not a whole lot to be worried about here in the short term when you're looking at so few needs to refinance a relatively small amount. Now, obviously, there's some companies that are in that situation where they have to refinance, 2% debt at 5% or 6%. So that's going to be a challenge. But there are so many companies out here that I just think it's something that we need to be aware of. Your thoughts, Ken?
I mentioned to Mark before we started the session that I thought he should copy this particular slide and send it to every single pundit that I watch on CNBC and all the rest of the business channels. They've been repeating every time they get a chance, they've been repeating how the rise in interest rates is going to come back to bite us in the next 12 months because companies are going to have to refinance all of their loans, all of their bonds, whatever they have out there where they borrowed money. They're going to have to refinance it at rates that are significantly higher than what they originally put the money in. The premise probably has some merit to it for a few companies, but these numbers show that the vast majority of money that's out there being loaned is not going to come due to after 2030. And if it's not going to come due to after 2030, I'm just not certain, since we can't even predict interest rates for the next 6 months. I'm just not certain we can predict what interest rates are going to be after 2030. Uh, I think that we're not paying attention to reality sometimes. That we say things that we've heard other people say, and we repeat it and repeat it and repeat it until it becomes fact, until it becomes truth. And this is a fact that I think at the very best is only germane for a few companies, and I think at the very worst, it causes us to be unusually fearful of something that has a very low probability of occurring. If you want to find out when the debt for your particular company or for your particular groups of stocks comes due, check the annual report. They show you the money that's being borrowed, and they show you for how long it is and when it has to be refinanced. You can find out if there are any companies in your portfolio that are going to be refinancing the bulk of their debt within the next year or so. And if that's true, that might be a problem for those companies.
Mm-hmm. Yeah, I might play with this topic a little bit. We just broke out some more debt characteristics in some of the work that we've done for the database at Manifest. So it'll be interesting. But again, it's not what many people are just blanketing us with concern wise. And no, Ken, I'm not going to tattoo this on my arm or anything, but but I do think it's a fairly important message.
Well, Mark, just to let you know, I know that Maria Bartoloma does not use this stuff, so we're safe there, right, Ken?
I will say again, Kevin, that since Maria has changed homes, I haven't been nearly the fan that I had been prior to the change of venue for her program, and it seems for her thought processes and her sense of how the market is doing and what happens in the market.
All right, enough with Maria. Although she will be back.
She's on the main page. We can't speak ill of one of our featured
one of our classmates. All right, from this morning's news, or at least this weekend's news, Warren Buffett's Berkshire Hathaway is buying those home builders we've been talking about. Loading up on some of those home builders. You see the three mentioned there in the article, along with continuing to load up on Occidental Petroleum and Capital One Financial. And Capital One Financial is a little bit turbulent, but I would point the audience to there's a whole lot of disagreement and unmatched opinions here when you look down that list and you see negative numbers over 100 for price to fair value, right next to something that is down in for sale territory. So confusion reigns. So a lot of times, and it probably matches up and rhymes with that chart right there. Again, you got to get very specific when you're talking about the impact on individual home builders. Location, as we've talked for quite some time. So, Ken, it must be comforting that Warren Buffett agrees with you again.
I just want to make it, I want to drive the point home that so many of you that I've been talking to in the last 7 or 8 months were selling your home builders at the very time when I think that you had the opportunity to buy extremely high quality, extremely decent stocks at extremely low valuations at PEs that were approaching 2 and 3 and 4. And instead, the choice was made to unload those stocks rather than add to them. I think it's one of the biggest lessons that we can learn when we're dealing with stocks where there's nothing fundamentally wrong with the company. It's something you have to keep asking yourself and keep trying to evaluate, and not be caught by the siren call of what the analysts are saying is going to come to pass. They have been calling for a recession now for more than a year.
Oh,
We've gone into the 16th month. We were in the 16th month now of them calling for an upcoming recession, and they're running out of time for this year. So some of them have begun calling for it in 2024 now. So,
well, a couple of very prominent, respected gurus, I wouldn't call them economists, but gurus, were calling for a -20 correction about 9 months ago. And you take that -20 and add it to the 20 that actually happened. They're only off by 40%. So nothing to see here. All right. So
on this point, I was going to say the other thing is that, and I've seen this with some clubs, is that they sometimes get a little bit too whipsawed because they tend to look at the timeliness ranking of Value Line, and we'll talk about that a little bit later on. And because it's down in the 4s and 5s, they get out of it when it's just like, wait a minute, the timeliness ranking is only looking 6 to 12 months out, and we're supposed to be looking 5 years out.
Precisely.
Yeah, you need to train a couple of people in every single club to just have one comment that they can repeat 5 or 6 times every meeting, and that's it. What's our time horizon? It's 5 years. What's our time horizon? It's 5 years in the future. And keep that at the top of our minds, not allow us to forget it.
Absolutely. All right, moving on, just a quick look at the Groundhog Challenge update. We have had major turbulence. Upstart Holdings actually had quite a tumble, so our previous leaders are all the way down here now. So they took a nice tumble down the list. Ken doesn't want me to mention that he's in the top 10 because that might jinx him.
Thank you, Mark.
So,
Mark, where is Ken again? I'm sorry, I didn't hear you.
Yeah. Did you say where Ken is?
I got to confess, he's also concerned about the scorekeeper on the last day being able to put Ken's name wherever he wants to. So, allegedly. All right, enough on that. Again, everything seems to be pretty much in order. We do have a new leader, Ann Renly, a very long-time participant in the contest. Good to see Ann up at the top along with Nick down at number 3, and some fairly common names that hover near the top. Seems year in and year out. Looks like it's going to be an interesting battle as we are only halfway, yet there's a number of people floating around there that are interested in Groundhog Gold. And for those wondering, Kevin is down at 58th, and his club is 52nd. So he's kind of like
one of my two.
So you're like Secretariat in the middle of the pack, just waiting for your opening.
Yeah, and I also did one with my nephew, and we're below the Mendoza line.
All right, moving on. Okay, not much change in our best small companies. Technoglass did have a tough week, but we have continued to make decent progress. We're getting ready for that Secretariat run of our own. Portillo's actually took a pretty good hit, so please get out there and buy some hot dogs. And we'll be back for a closer look at this in the future. All right, this article is kind of the inspiration for where we're going to head today. It's an article from a couple weeks ago in the Wall Street Journal. It has appeared in a couple of other venues, and they're basically talking about how we went through a period where investing got a little bit weird. In fact, I did a little bit of weird investing that we don't need to talk about here, other than to answer the question, yes, I still hold shares in Western Alliance. For those of you that are concerned about it, I probably average a couple emails a
A2
week.
Milk, how you doing there?
I do not continue to hold A2 Milk.
Good.
There is some promising stuff there. But anyhow, this is just an article which basically points out that the quality of companies matter, and it kind of sets the framework for what Kevin's going to walk us through with respect to quality and this notion of a very long-term perspective. And down at the bottom, we actually covered Raina at Poland Capital a few months ago, and so she's also quoted here. Lots of good, clean fun. Just as a
Mark,
yes, sir.
Before you leave that article, maybe you want to underline in the second paragraph down the words steady profit growth and low debt. That looks an awful lot like section 2 of the stock selection guide right there. And remind yourself that you don't have to get really fancy to be able to follow these kind of numbers on a yearly basis. You just don't have to get drill down into trying to figure out what's going on with the debt of a company if it remains relatively low. You know, if a company has only 3% debt to equity, when they're going to refinance, it doesn't really bother me too much.
Absolutely. And I do like this word resilience for quality also.
Absolutely. Yeah, you're right. You're right.
That kind of stuff. But that does set kind of the framework for just pointing out, and I mentioned last week, I probably will go back and take a look at the Fortune series with Warren Buffett and doing the impossible. Here's just a quick reminder, and again, some perspective on some of those high quality companies which reside near the tops of our portfolios. I own 5 of those. I think Ken probably owns 6, if not 7 of them. And those companies are the type of companies that we hope to kind of talk about here for the next half hour or so.
I will confirm, Mark, that all 7 of these reside in either one of my IRAs or my wife's IRA or our after-tax portfolio. One of those 3 places. All 7 of these stocks I own. Yeah.
Wow. So you should buy dinner.
Well, I'm lagging. I only have 3.
Okay, pay attention then.
I obviously got to listen to the teacher.
This is kind of the other inspiration for the remarks here today by Kevin, and we'll be chiming in on him too. But in that book he's about to talk about, here is a list that we published almost 10 years ago at Manifest Investing, when Arnold Bernard actually goes through and talks about recognizing the quality of companies. And Kevin's going to cover what that definition is. But we have found, and we continue to find it absolutely fascinating, that over here in column A, you basically have a fairly short list of companies, all but one of those. And in fact, all of them were still in existence 10 years ago. And we just fairly recently lost J.C. Penney, the first one to fall. And it's just kind of fascinating when you think about that being 65 years and that list staying intact. Now, there obviously were recapitalizations and changes and mergers and spinoffs and all that kind of stuff. But the core companies that are listed there in the middle, or in the left-hand column, list A, they're still around. So that's kind of the inspiration of how do we think about seeking those types of companies to be around 25, 50, even 70 years from now, which almost seems like an impossibility. And Ken, you were noticing some of those down the middle aren't too bad.
Well, I was noticing a lot of them are gone, but there are 3 or 4 stocks down the middle column there that I'm not so sure that I don't think they have highest quality as well. I draw your attention to Colgate-Palmolive. I draw your attention to Maytag and Westinghouse. I don't remember, frankly, whether they're still both independent companies or whether they've been snapped up by somebody else, but those certainly at one point were pretty high quality issues. I know an awful lot of them on that list are gone, however.
And almost the entire column C is gone.
Yeah.
In some way, shape, or form. So with that as an introduction to that's the frame of mind we want to be in, and Kevin and I have been taking a closer look at this book, and again, Kevin, take us away.
Okay. Yeah, I mean, I've always sort of wanted to look at this book and sort of look at some of the early years of Value Line. And when Mark was talking about it, I thought, okay, I found it on Thrift Books and took a look at it. If you get these slides, I have a lot of hyperlinks in here that you can sort of take a look at. And this comes from different sources. I sort of like to look at some of the background, and you can read his obit. But one that I found was really interesting is his first job on Wall Street was working for Jesse Livermore. And if people don't know who he was one of the great stock speculators in the pre-SEC era. So in the 1890s through the 1920s, he made and lost millions. And he would probably be the equivalent to what we call a day trader. So his first job was working for him. He gave him a report on copper stocks, and Livermore immediately shorted it. He then goes over to Moody's and is a railroad analyst, but also being an account manager. And he notices there's a rating system for bonds, but not for stocks. And he lost his job because of the depression there. And that's when he sort of started out Value Line with a lot of his, some of the clients that he had over at Moody's. They wanted to see it. And he eventually finished out on Forbes 400 as one of the wealthiest Americans around. Just kind of an interesting character all along. Let's go on to the next slide.
I was pretty surprised to see him on the Forbes 400 list, Kevin. That's new for me.
Yeah, whenever it was, I forgot. I should have found the site and put it on there. So I usually like to put hyperlinks to find it. But here's the thing: is that they always talk about Value Line starting in 31. They did, but he didn't start doing the Value Line as we know it, those stock reports, until 1937. He covered 100 stocks, and he did them monthly, and they were called the Value Line of normal data. And what he was trying to do was find out what would be the proper value for stocks. And it gets back to, again, there was a rating system for bonds, but not for stocks. By the time this book came out, there were 804 stocks, and the inside back cover of this book, which was from 59, was talking about how they were moving to 1,000 stocks. So here it is, they, eventually by the late 70s, they were covering 1,700. You can see some of the things that were, some of the other things that they did. As I was telling Mark during the reading, what was kind of interesting is when this book was done in 59, it was really in the early years of using big computers to be able to start doing some of the investing stuff that we talk about. Sam Eisenstadt, who was his longtime person there at Value Line from 46 to I think 2009, he was talking about all the computations that they had to do by hand. So, the S&P 500 didn't start until the mid 50s. It just back tests to 26, but it was, so all of these things are sort of happening on. And if you look at it, when he dies, his daughter takes over and they roll out all these other products and stuff like that. So really the things that Bernard was working on, some of those things were not there when he passed away. So just sort of an interesting background. I didn't realize the Selection and Opinion didn't start until the late 80s. So I thought that was kind of interesting.
Yeah, at one time I probably had all of those in my storage room too.
So, here are the quotes that I think we see all the time about this. And Value Line is no problem emphasizing the first two, Buffett and Lynch. And, you had up on the forum just last week about Walter Schloss. He worked with Benjamin Graham and shared an office with Warren Buffett. And they would basically peruse the Value Line to be able to get their stock ideas. So, yeah, it's it really, really became the point that everyone looked at in the mid 60s, and we'll talk a little bit about why this was. So the stuff we're talking about with this book is before it really became the point of being the investment guru that we look at now. So, and yeah, here are the things that have fallen flat. And if anything, you can look at it as some of it can even be traced to the daughter sort of running things. She's cannot do the day-to-day running of Value Line because she's, they were basically double dipping on their, I think it was their mutual fund, wasn't it, Mark?
Yeah, I don't remember the specifics of the controversy, but yeah, there was something that she was penalized.
Yeah, two slide back. It was on her 75th birthday. The courts ruled that she cannot be there running day to day, and she owns that 81% of the company today. She had a twin brother, big contentious thing, moved him out. He has since passed away, And so basically this is her baby. And she even moved out some of the people like Eisenstadt when they didn't genuflect enough to her. So, and Mark didn't know that it was actually an individually traded company. So there's its SSG, and we just finally, with the latest update at Manifest, there's now, you can look at the quality and par rating for Value Line. You can see he has the stuff up there too. So, just sort of to give you an idea of where it sort of looks.
Yeah, they're in a tough business. I mean, you look at the work that they've done with libraries and everything. That growth line is very flat, and it's expected to be flatter or down. I don't think that the analysts who cover Value Line are completely fair or unbiased. They tend to be a little bit derogatory and negative. So some of those numbers on the far right of that chart probably fit that description.
Yeah, and I think with the advent, and Ken was talking about this, I think with some of the technology, back in the, I think it was in the 90s, they had like about 130,000, 140,000 subscribers, and they're down somewhere in the 70 or 80,000 now. So,
which
anyway,
is some, yeah.
Yeah. So this book is really a transcribed version of lectures he gave at Baruch College the year before, so in '58. He talks about, this, they've been doing this for 21 years, since '37, and he goes, it's still imperfect, and he even goes through with this and points out some of the things that have sort of evolved in sort of their things. And what I was telling with Mark is that, he talks a lot about yield, and we'll get into that in just a moment, but if you look, you got to remember sort of the environment we were in. We were still on the gold standard. Inflation really wildly swung from year to year, and the yield on stocks was at least 4% through 1960. I say 1960, it's actually 1990. That's an incorrect on mine. So it's just really, I forgot to edit that, but that link will take you to for yield will take you to Investopedia article, and they'll show you a visual analysis of the yield of the S&P 500 by decades, and it really sort of shows that up. But again, there was, and the way to be able to be a low-cost buyer would be to do dividend reinvestments. You had to buy in round lots to start, so there really was only the S&P reports and really nothing else for the individual investor to look at other than brokerage reports. So you're really almost feeling like you're flying blind compared to where we are now.
Yeah, and if you think about that, flying blind into the 1960s, that's a full, 30 years after the 1929 incident. And, the OK Corral, the gunfight at the OK Corral, and the wild gunslinging days in the stock market. And still that was not really fixed until that time frame. Charles Schwab came along and kind of helped with that in the 1970s also.
Kevin, isn't a companion fact to your set of facts here also that companies very rarely bought back their own stock? It was a strategy that was not employed to any great degree in the 60s and 70s, that if they were going to give money back to their shareholders, they did it through a dividend. And that's where that 4% comes from, don't you think?
Yeah, the short answer is I don't know for 100% sure, but based on what you're saying, that would tend to make a lot of sense to me too.
Mm-hmm.
The other point that I'd like to make to remind the younger folks in our audience, if we have any, is that when we're talking fees for brokers in the 60s and 70s and 80s and even into the 90s, we're not talking $3 and $4 a trade. We're talking hundreds of dollars to make a trade in the stock market. I started trading in the 80s, and in the 80s, a typical fee for my broker to execute a buy or a sell was $125 in 1980 something money, not in today's money, in $125, which was worth quite a bit to a stock trader. It took quite a bit off the front end profit of anything you were looking to invest in at that particular time.
Wow, it's even hard to imagine in today's world.
One other thing before we go, the thing that I find kind of interesting is if you look at people like Arnold Bernard or Benjamin Graham, T. Rowe Price, David Babson, Phil Fisher, Benjamin Graham, all of them really had their first experiences prior to the regulation of the stock market in 32. So they've all sort of, in different ways, lost a lot of money, and they had to figure out a new way to sort of evaluate stocks. They came across it on several different ways, but they all have the common experience of having really taken a major haircut because of the Depression. Bernard did, Benjamin Graham did, T. Rowe Price did. So there's, quite a few that lost a lot of money because of that, and they were trying to figure out a new way of how to be able to evaluate their companies.
One last point that I'd like to make, Kevin, is also that the instruments that so many people use today to trade their stock, which is actually sitting behind the tax screen, they hold their stocks in IRAs or in 401ks, and they're able to make buys and sells without having to consider the tax implications of what they're doing. Those were completely unheard of back in this time frame. Every single trade that you were making had tax implications, and that had to figure in to every single thing you were doing. The taxes were granted a lot less than they are now on capital gains, but at the same time, there were implications for every single trade that you made.
Mm-hmm.
Yeah,
Absolutely.
I have a quick fun fact for you guys. In my copy of the book, I actually have a Reader's Digest insert, and it suggests that the long-term capital gains period back in the 1960 time frame was 6 months. It became a long-term capital gain after only 6 months. I had never seen that anywhere before. So,
wow,
makes me a whippersnapper, I guess.
Well, among the three of us, you are.
All right, carry on.
So Mark had this in his stuff, and I saw it too. It's right up on the front cover. And this really gets to sort of the heart of what Bernard was talking about, is that there's, what is the value of a stock? And people can't tell you whether it's, too high or too low, and that's basically the premise for why he was trying to figure out what would be the normal value of stock, sense of value line. And while he predates the efficient market hypothesis, which came out in the mid-60s, there were clearly numerous people prior to that were already advocating for the random walk, the efficient market, that, you can just sort of do this all along and you'll be fine. And Bernard was more like Benjamin Graham on a value sphere, but as I really found out through all this, he really liked John Burr Williams, which is a person who really is the first one to come up with the whole idea of intrinsic value. But Burr Williams was doing it with dividend as the determination of future value. Whereas if you hear like Warren Buffett or a lot of these discounted cash flows now, they're trying to figure out what the cash flow will be in the future and discounting it back into today. So it's a different calculation, but that's really where it comes from. So those are probably two sides of the same coin in terms of John Burr Williams and Benjamin Graham.
Yeah, and again, a footnote, that is what drove the dividend discount model portion on the backside of a stock selection guide back in the day when, as we're going to cover, dividends were kind of the rule of the land.
And that link to the John Burr Williams, I think that takes you to a CFA article that talks a little bit about the difference between John Burr Williams and Benjamin Graham. So, so what he really goes through in this he has 4 chapters in this, and he really sort of outlines, I think we have it a couple slides ahead here. He basically thinks there are 4 points, and it's on the inside back cover, that there's basically 4 points that you need to sort of look at to determine value. And so the first thing he talks about is that you have to figure out what the value is. And he says, he even quotes Charles Dow, who did the Dow theory and was a chartist, that Dow said the first thing to be able to figure out, how your chart looks is to understand value. And Bernard is like, well, what's the value? And so, he keeps coming back to that, is you have to figure out what it is. And one of the things that sort of comes out there is that he will sit there and he comes out to, he doesn't think that there's a standard PE ratio for the entire market. We generally hear some things there. Now in our community, we don't do that. We try to find the unique, a signature PE or the 5-year average PE for a company. And he goes through this whole setup, Bernard does, trying to be able to tell you why you need to look at each stock individually to be able to figure out its own unique PE ratio, which seemed to be pretty radical. I can't say for certain if that was radical compared to other people, but wouldn't be surprised if it was. But, and he also then talks about, you have to be careful of cyclical stocks because of, what their PEs will look like, for the reason that we know is that usually, when their PE is really, really high, that's a great time to buy them, and sell them when they're really, really low because of the math that goes into a price and earnings ratio.
Yeah, and again, just a note, many of the people in the audience for quite some time kept asking Ken and I, why don't you guys cover more on inflation and the impact? Now, I'm not saying for even a heartbeat that it doesn't matter, but it's not a large factor, as is made in the point here.
Exactly. He basically talks about this, that there's really no, that inflation has way too much of an influence on what's going on. And he thinks that the primary influence on how a stock does is its dividend paying ability. And that gets back to the higher yield, and probably also gets back to what Ken was saying, that people didn't do dividend reinvestment. So this is a way that they could, reward their shareholders.
Yep. And in fact, Nicholson wrote playfully about how inflation actually improves your growth rates on a stock selection guide. So it's just it's a deep subject, but one that probably shouldn't get a first order importance.
So after he goes through this, then he starts to be able to talk about what is a concept of quality. And he goes through sort of his things, and he'll tell you how he sort of calculated these things, sort of a +1, a -1. He was looking things over a 10-year period in the past for earnings and sales and debt and book value. And then he looked at it over a 5-year period and over a 3-year period. And what he was doing was not just looking at it 10 years and 5 years and 3 years. He was looking at, if he wanted the 5-year, he would look at the 4, 5, and 6. If he was looking at the 3-year, he'd look at the 2, 3, and 4, and on and on. And he was looking back historically, not 10 years, but more like 20 years to be able to come up with these things. And so the whole point of that was to be able to sort of adjust for the cyclicality. Again, there were much wider swings in terms of the inflation rate, in the GDP rate, because again, we were tied to the gold standard, which we didn't get off until 1971. So he basically comes up with a quality ratio. Some of it, this quality ratio, some of it he talks about safety. So you think, it's a safety ratio. But the calculations, it says there's done over 9 brackets. That's the financial strength. So it's this quality grade that he has is somewhere between a financial strength in a current day value line and the safety ranking. So, and the other thing is that if we go back to the previous slide, if you look at Value Line, and they do have their own YouTube channel where they have a one stock to buy at the end of the month, and they'll sort of take you through a screening parameters that sort of select down to one that they have. And guess what? Like 3, if not 4 of the key criteria that Bernard is talking about in 58 and 59 are pretty much part of the screening criteria that Value Line does on its current YouTube page. So I found that really, really fascinating.
It is. We're going to show a little bit about that, Kevin.
Yeah. And so the next thing is, he talks about the quality grade being backward looking, and we can say the same with Manifest's quality ranking. You can look at it on the SSG where you have the Morningstar Financial Health. That's a backward looking one. CFRA uses the Standard and Poor's quality ranking, again, a backward-looking one. And so he says there's no way, to really sort of estimate future earnings and dividends. And then he basically goes through trying to project 3 to 5 years out. And he uses sort of larger macro issues, like he uses the example of GE and, looking to see, how many, what the monthly hours were, or the weekly hours for workers are, or, what their disposable income is. And those types of things to sort of come up with a sort of a larger macro sense of things to go on. And so, he talks about this as it's really hard to be able to figure out how things are going to be 5 years into the future. And I think most of us, particularly if we're new to this, the hardest thing is to be able to convince people how to estimate their future sales and future earnings. Mm-hmm. And he basically is saying, if you look at it over a weighted 3-year average, as Value Line does, so if you're looking out 5 years and want to look at 4, 5, and 6, it takes out some of that cyclicality. We don't have as much of that now as we did back then, but it really does sort of help. And what he's trying to do is not, it's not a forecast, it's just sort of a plausible hypothesis. And that if you're in that kind of range, you'll be okay. And that's basically what he's doing there. And the bottom line is that if you see there where he says the original Value Line ratings in 37, the last bullet point there, were based on the premise that earnings or dividend paying ability, again, going back to John Burr Williams, determine the price of the stock. And by putting in a book value factor, we got a pretty constant number, and we added a multiplier with earnings. The original Value Line, we'll show you this in just a moment, was basically a book value and earnings. And they were laid out manually, is how he did it. And that was basically the original Value Line in and of itself. Mm-hmm. But he said the hardest problem was, trying to figure out this 3 to 5 year appreciation ratio, because of the fact that, there are just so many different variables. And he wanted to do it not just by optimism, but by using quantitative measures. And that's basically what he was doing there. But again, the 3 to 5 year appreciation potential, you see that on the Value Line today. It's mm-hmm. still there.
Yeah, and I think this statement is pretty powerful as it aligns with our assumptions about investing and analysis. Higher quality stocks are just easier to forecast. They're more dependable. And mm-hmm. That's something that he proved in very empirically in a big way. All right.
So there it is. This is I was asking Mark at the beginning, I said, what's the earliest Value Line that you have for an individual company? And you said, what was it, like mid-70s or so?
Right.
Yeah. And so I wanted to find one from 37 to take a look. And then sure enough, as I'm reading this, I call up, I think it was yesterday, Mark, I said, I found it. This is original Value Line. Yeah. This is the original Value Line. So this is over 2 pages in the book, and this is GE from 1943. And again, they visually fit that Value Line. There's the price, the weekly price bar, just like we see on a Value Line there. And anytime those prices are above that Value Line, they're overvalued. And when they're below it, it's undervalued, exactly like it is today. And he goes through this, and it's a little hard to see, but the calculation was book value plus earnings. And that's how he came up with this. And then he laid it out where he thought it would fit. It wasn't until Sam Eisenstadt came around into the 60s that they finally started to do it more by a computer base. It was more just sort of an intuitive feel. But over on the right-hand side that's the projections, the same stuff that we would see when we're projecting on the Value Line. Now, the price bars that he has there, those are the ones that are the actual histories that happened, because again, this book was written in 59. And so he just sort of takes 43 and just sort of extrapolates, this is what they were projecting and this is what sort of happened. And so I found it really, really fascinating to see where we are.
Yeah, we might play with this one in a little bit more detail. So that's hence the to be continued, because it's kind of an interesting way to think about. And again, he cautions against making a judgment about any one stock. It really is groups of stocks but this could get interesting, Kevin.
It is. So, so here's what we have here on the a summary from the inside. These are the 4 desirable things. He's looking for market performance over the next 12 months. That's an early version of the timeliness rank. The timeliness rank that we use was set pretty much in 65. Here we are. We have the 3 to 5 year appreciation potential, which a lot of us use to help set our prices on the SSG. We sit there, and quality, whether we call it a long-term safety, whether it's a safety ranking, or whether it's financial strength. And then the one that we really don't use that much anymore, but yield. And so, it was basically these things that sort of are the basis for what he was doing. And again, using yield as, making sure that he had that money coming back in was critical to being able to do this. But he goes through a lot of different tests. He compares himself to things like, he looked at Benjamin Graham and security analysis, as well as the intelligent investor. And he points out in chapter 3 a lot of reasons why he doesn't really like the Graham way of approaching it, because it's too subjective, and you need to have something that's a little bit more quantifiable, is basically his approach. So if you were to put him between the two, he's more like John Burr Williams, but he does understand the value of what Graham is doing.
Yeah, and Eisenstadt probably helped out a lot with that also, Kevin. And then this last comment here, this one, he wraps around a couple of different portions in the book, and he just emphasizes that, again, the rule of 5 really does apply. So you have to look at groups. And I thought he kind of stumbled through it as he was talking about it. It's something we might take a closer look at. But again, it's the way that we deal with relative performance is probably the right way to think about that. And we'll just continue on. Well, Kevin mentioned that there's a value line channel. I went back, Kevin, and took a look at the last 12 selections by their YouTube programs just for kicks. And they're not doing bad. They've got some interesting picks in there, and nothing that's really gone too nasty on them, except for Mosaic maybe a little bit. Just kind of fascinating. And
again, it's going to be a little self-fulfilling prophecy because of the fact that they usually have they're usually looking for something with a timeliness of 1 or 2.
Mm-hmm.
So therefore, it's going to have more of that short-term bump. But they almost always have their safety and financial strength metrics right up there at the top.
Of interest to our subscribers, I did have to add CVR Energy to our coverage. I wasn't aware that we weren't covering it. Interesting. All right.
Interesting, Mark, that my clubs only own 1 stock on that list, and happens to be one of the top performers. It's FleetCor. That's owned in 2 of the clubs that I belong to. I don't own it myself, but FleetCor Technologies seems to be having quite a year.
Yeah, it's a pretty good list, in all fairness.
Yeah.
And FleetCor is a big part of some of our portfolios here.
Yep.
Interesting stuff. And they've come around to Visa, MasterCard, etc. up at the top there. They're good programs. I would recommend you take a look at them. The recordings of all 12 of those are there. So here's, Kevin, here's kind of the wrap up, my interpretation of that last slide and how we kind of think about the planet today. And I think the graph you pointed out really does kind of drive it home.
Mm-hmm. Absolutely.
Here's where he wrote the book and Kevin and I were born. And you can see that there's definitely a whole lot different level of dividends to the left of that arrow than to the right. And in most of our careers in investing, we're down getting pretty used to these numbers. You know, whereas back in the days of Nicholson and the early days for Value Line, if 10% is where the return on a stock came from, as much as 7 to 80% of it came from dividends. So hence that's why you saw such a emphasis, and so that has to be adjusted. And again, that's our reason for suppressing it in the definition provided by Benjamin Graham and George Nicholson. When we look at quality of a company now, we do not pay as much attention to dividend as they did back then, and this is why right here. All right.
So that number that's really where the yield's really high, is that when Ken? Is that when you were born?
Thank you.
What's that, like 32, 33?
What, 32? Yeah, that's it.
You're well preserved. You're looking really good, sir.
I will say, Mark, that this graph just puts it right in front of your face. Why people should be very careful reading about income investing, investing for the dividend from sources that come from the end of the last century, and then taking that knowledge, taking that advice, and pushing it into the 2020s and 2030s that are coming. We're talking about two different worlds. And because we're talking about two different worlds, I'm not so certain how a lot of that income investing advice holds up anymore. And I think that's the point you're making, that we probably should be looking at total return forecasts, which include dividend, and that's the point you're making on the right here.
Yep. So, I mean, when we do this stuff, and we're going to actually go through a series of screens, we'll run over a little bit, but I think it's worth it to go through them. We look for promising returns and excellent companies. And then if they happen to be temporarily oversold, all the better. So let's go ahead and take a look at a few. I just threw this one in here because it's something we put out this week with our favorite 5 screening results, just to make the point that we are looking at a number of things when it comes to the financial strength of a company. The value line definition is also right there. This is the value line definition of financial strength that Kevin has covered. But we actually incorporate a consensus view of various other factors, and including these last 2 components down at the bottom. So that's where we go shopping. And there's some interesting companies on that list on the right, and we'll just kind of scroll through some others. But some of our electric companies are there. Forward Air is in there, Ken, and could be interesting. But let's take a look at some of Kevin's results, and results that I actually went and did what was just from this slide right here: above average return forecast, differentiated excellent quality, and an RSI, meaning potentially oversold, and ran it at Manifest. Get a very similar list, but again, a number of companies. Again, double-digit return forecast, excellent quality, and a relative strength index less than 30, which means it could be temporarily oversold or perhaps a buying opportunity. And there are some fascinating companies on there. In fact, I would throw Forward Air on the pile as one to be considered for our 2048 basket. And I do want to dig in a little bit deeper. Kevin and I were talking about this earlier. They had I believe a 30 or 35% price drop in the last couple of days.
Plus.
And there's a really simple question here. Are the rhinos, the Wall Street analysts and institutions, right about they've just got the heebie-jeebies over a merger / acquisition that this company is doing? Forward Air is one of our favorite. It's a long time. It's a multi-year contributor to the best small companies, and it's been a good company, and they have a tremendous positive catalyst in the challenges facing Yellow Corp right now. So field of opportunity is strong. And I guess I would just throw out the question. I might put it on our forum. How much did they overpay? Does somebody have an opinion, or can they find an opinion about how massively overpaid did they pay for this Omni company?
I also want to put a big red arrow about halfway down the list, Mark, on ResMed. ResMed has been a long time holding in some of the clubs. I own it personally, and it's taken a really big drop after the last earnings. I think unduly penalized for what's going on, and I think that in the long term, this is something that you might it the suggestion might be that this one is severely undervalued at the moment, and you have a pretty decent quality rating to go with a fairly decent par value.
And I do
What
like.
I would do is
Go ahead, Kevin.
go ahead, Mike.
No, you go.
All right. So the ones that sort of stand out to me on this list are actually Solar Edge and Enphase. I mean, look at the growth rates that they have there. They're solid quality companies. And this gets back to what Bernard was saying, is that he goes, one of the things he wanted to do with the quality ranking is that he was like, what if you had to invest in the market and be away for 10 years? And so if you have a really, really high quality company, and they also have, and you know, their book value and some of their other things are pretty good, but at growth rate would seem to indicate that they have probably some good long-term. I don't know what Doximity does, but that again has a really high growth rate. Those would be the ones I would be, if I had to buy and not sell for 25 years, those would be the three I would probably first jump towards.
Yeah, and Enphase was featured in our electric portfolio a few weeks ago. So it's one they make all the gizmos and gadgets that go on electrical systems and transmission systems. That's what they do. So probably a pretty bright 10-year picture, and probably
no
20.
pun intended, huh?
Yeah.
For those of you sitting in the audience with a low-tech pad and pencil, what I'm doing right now, and what I do every time I see a list, is I don't jot down companies I know a lot about, but I do jot down a couple of names that I don't know anything about. Doximity, for example, even before Kevin mentioned it, was sitting on a very short list next to me right here. I do think, Mark, that this list might pick up companies that are having that we're severely overvalued and might be coming back to earth.
Yep.
And I think that this particular screen might be sensitive to that kind of behavior. And I'm specifically talking about Chipotle down at the bottom, this Albemarle with all the issues
Lithium,
that there
yeah.
might be about the nationalization of parts of their company. But I think you have to be careful that this isn't necessarily giving you a buy list. This is giving you just a list of possibilities. You're right, Doximity with a 55 projected PE, Novanta, which is another one that I wrote down on my list here, which with a projected 54 PE. Maybe I've already found the reason why I don't follow them very carefully. I don't know.
All right, let's press on and take a look at a few others. I think, Kevin, this is one that you provided.
Yeah, I did. And I even tightened up some of the parameters. But again, the whole idea was getting a really good quality, getting a good core score, and that growth rate. Because again, I wasn't looking for relative strength, because if we're looking long term, to me, relative strength is less relevant. You know, I wanted stuff that was high on the manifest rank. So I knew I was going to be getting something good. I had at least the core score of 225. And I figured that if it had more growth, I have a better shot at finding things. And if you look at that, there are a few that sort of show up in our community. We talked before we got on here about MP Materials. There's InMode, which is in one of my clubs, but not in my other, because someone in our club put the kibosh on it in one club and not in the other. And in return, they ended up having to become the stock watcher for it. I won't mention anyone's name, but it happens to be someone who's on this call right now with us.
Let me know if you need some materials, Kevin.
Yeah. But Generac is there, but Lululemon show up. But there's Axios, Fabrinet, Arista Networks. Those look really, really pretty good. And I think Arista Networks, I've looked at it a few times. I don't think it looks super great on the SSG, because if I remember right, it kind of bounces around.
Sure.
But my goodness, it keeps showing up in a lot of screens that I see.
Yeah.
I'll tell you another one that you might take a real serious look at ASML. which has the technology that every single chip maker in the world has to be using right now to produce these sophisticated chips that we've been talking about. ASML is look at that growth rate on that company there.
Mm-hmm.
Good stuff.
And when we're looking at high growth rates, if you go back when I know Ken has probably written down number 2 on that list. You really like those Chinese companies, right?
I just love them.
He's all over that.
First thing I chose, that one, and then Generac. I put that one second on my list. Okay.
So what I did with this one, this is the value line screen if you have the library and went through it. And what I decided to do was try to take what we had just finished talking about. So I was using the safety and financial strength numbers. And then I was looking to see what had good book value growth and cash flow growth and earnings per share and sales growth. And not looking for any price projections, because again, we're looking out 30 years. So who knows? And maybe I made these numbers a little bit too tight, but I ended up getting 5 on there. And we have Copart, we have CoStar, Monster Beverage, Regeneron, and an Amazon.
An Amazon, yeah. That's a good list.
So that's a really interesting, and we're going to be talking about, you're going to have Hugh come on in and talk about Regeneron, right?
That's correct, as early as next week.
Yeah.
Okay, good stuff. Well, I took a similar approach, Kevin, and just for kicks, I limited the financial strength to A plus, and A double plus, safety of 1 and 2. So that's kind of the Bernard definition. But I actually went in and used the forecasted sales growth rate, and I actually included a total return forecast just to generate a fairly interesting list of companies. And I consider this to be an equally interesting shopping list. There's just
I mean, I'm looking at, I see Taiwan Semiconductor looks interesting. I'm trying to see, like Ken, let me see if I can find ones I don't know that I ought to. I tell you, I've looked at Robert Half and I just can't figure it out. But darn it, if it doesn't show up in a lot of different screens.
Well, they're
RHI.
outplacement and career counseling, and they're very good at it.
Yeah.
I just added more CVS and Starbucks to my IRA portfolios.
Yeah, I think Starbucks is compelling here. If I were forced to name a company for the 2048 portfolio today, it would probably be Google. Down here,
I'm going to go one right above it. I'm going to go with Edward Life Sciences.
I knew you like that one.
Yeah. For those in the audience, next week I will be 5 years since I had open heart surgery, and Edward Life Sciences works in the cardiac care, so I have one of their products in my chest. But the cardiac community, the need for being able to have cardiac surgery continues to grow. So Medtronic is a competitor to them, and they're in the S&P 500. But it's really hard to find them when they're on sale if we use the SSG metrics. But it just has good steady numbers, low double digits.
I'll tell you, a company that keeps popping up on lists that I do is Tractor Supply. I can't warm up to it, but golly gee, it's on 2/3 of the list that I put together. TSCO down about 2/3 way down the list. Yeah.
Well, Home Depot reported today they actually had good results, but they did guide lower. So it'll be kind of interesting to see what that bigger picture looks like. Interesting to see Nike on here too. Again, keep in mind, we're thinking about companies that we expect to be around 10, 20, 30 years from now. So we're trying to hone in on some of those. And the other thing I would point out to you guys is these growth rates on this column here, those are right in the sweet spot. That mid-range growth rates that we've talked about so many times for smaller and medium-sized companies lately. So kind of neat stuff.
And I see your favorite up there, Comcast. Do you love that one?
Comcast almost got trimmed off the list. And they're on this one too. I tightened it up to just be safeties of 1 and financial strength ratings of A or A plus or A double plus. And again, very strong list. I would probably go with Alphabet for the long term at this point. But there's some.
I tell you, I don't think you can go wrong with Taiwan Semiconductor either.
No, I think they're leveraged for a strong future. Of course, that's what we said about Nokia about 10 years ago.
Well, Mark, I'm going to remind you that we tend to, you and I at least, tend to shy away from anything involving a food stock, Portillo's accepted. But I don't think we should write Starbucks off of anything that we're doing. This thing is ubiquitous worldwide, and it's only growing. You know.
Yeah, I am a shareholder in Starbucks, so I'm pretty familiar with the company. I think with them, the only thing you have to worry about is when we have enough outlets globally.
Well, we have a
And one
couple
of
of continents where they haven't really started yet, so that might be 40
going
plus years away. So
Comcast, just to say, for those people that have a Barron subscription, they had a good feature on them. And, even though people are cutting the cords and stuff, they were really showing 6 different growth venues that they had that were still going to help them go long term. So if you can get access to Barron's, you can take a look at that. It was interview with the top dogs at Comcast. They're into streaming, theme parks, and content creation themselves.
That's in my stack of reading, thanks to you, so I will take a look at it. All right, so we'll go ahead and begin forming some thoughts about that 25-year portfolio and begin putting it together. We do want to compete directly with a target date fund for 2050, and it's not exactly a fair fight, but let's have a go. And I just jinxed us. I just completely cratered us with that statement, but we will be continuing down that path. We are up on time. Just wanted to point out that it's likely that Hugh McManus will join us next week to talk about FDA pipelines and specifically about Regeneron, answering some of the questions about their pipeline. And then within the next couple of weeks, we will actually be back with an update on the Thrift Savings Plan, one of our most popular programs. I've been extremely remiss in not getting back to that in recent years. Here's a reminder that we do archive all of these presentations on the YouTube channel. We also put copies of the slides in the Manifest forum. If you have any questions or if you would like copies of the slides and you're not a Manifest subscriber, just send me an email, mark@manifestinvesting.com, and we will take care of you. And I thought we'd close just with a Hawaiian prayer for all that's going on over in Hawaii. My wife and I actually honeymooned in Lahaina and went back there 10 years later, and this kind of breaks our heart. So we just hope that I'm just sending hugs, thoughts, and prayers. And last but not least, our closing slide. We continue to think that it is possible to imagine groups of companies being rewarding over a 25-year time frame. And just want to thank Arnold for his contribution to the world of investing. And thank you, Kevin.
Sure.
For
I found it fun.
Continuing contributions. Anything else in the hopper, Ken?
no, I've kept up pretty closely. Thanks to Len for keeping me honest and keeping me informed here, as always. And nothing else to say except good evening, and we'll talk to you from the mountains of Tennessee next Tuesday, okay?
And I will do all I can to resist putting out images of Kevin like Judd Nelson at the end of Breakfast Club.
Okay, great.
A low bar.
Or Judd Nelson today, maybe, huh?
Hey, there you go. That's a possibility. All right. Well, again, thanks, Kevin, and we will continue in some ways with this theme, and maybe a little bit more on the value line. And again, if you have any questions, let us know. Thanks, everybody.
Bye-bye, everybody.
Good night.